Mayuresh Joshi joining us on the show today. Mayuresh, great to have you with us. It's been quite a topsy-turvy week in markets trying to find their feet in the middle of all of this. Now that, of course, we've seen the Brexit vote, and amazingly, it came in for the exit rather than remain as the street was expecting. How much more volatility do you expect to see going ahead?
Hi, again, I think the volatility will continue for some length of time, and that's to do predominantly with the vote going again. So I think the Britain exit was a rude shocker for a lot of market participants, and that's getting clearly reflected in a lot of asset classes. So the risk of trade probably has just got begun, in my opinion. I think the consolidation probably might happen at lower levels. But again, I think the global markets will be very, very jittery, at least for the next few weeks. I think India will react to what the global markets have to say. And again, I think our reaction will be on the softer side. So I think expecting the markets to probably head lower, probably consolidate. And again, I think the longer term trends for India should stand out, whether that be corporate earnings reviving, whether that be a good monsoon expected to come through, whether the expectations of GST getting cleared. So I think all these factors probably help India in being a very sweet spot. But again, I think the collateral damage will be felt by India in the immediate short term.
Mayuresh, what's the kind of key events that you'll be watching out for now? I mean, is the focus going to be, first of all, on the new leadership that comes in, whether it's in the UK, whether it's even in the US, how the EU now reacts to this? Are there going to be other countries that perhaps start to look for a referendum? A lot of instability that seems to be on the radar over the next 2 to 3 months. What will you be watching out for?
Well, yes, again, I think the instability and the uncertainty related to what happens with other countries opting out, going ahead, what happens with the EU, what happens with the euro, what happens to the major currencies if the dollar strengthens and the other currencies depreciate, including the emerging pack, what happens with the forex reserves on that front, what happens with the FTA agreements, what happens with trade negotiations, what happens with the amount invested in Great Britain itself by a lot of financial institutions, the cost of operations going up. I think a lot of factors that one needs to probably watch out for over the next few months, and how Britain is going to probably cope that up in terms of the negotiations going with the European Union, and what happens if other nations start opting out of the European Union. So I think that's going to be a big question mark. The Fed policy, again, expected to be in July. I think largely now a lot of market participants are of the belief that that might get delayed. But again, the US presidential elections, and on our own domestic side, I think all the factors, including monsoon, the monsoon session of Parliament, I think all these factors probably will be keenly watched out for. And that will probably create some amount of an overhang, not just for the Indian markets, but the way the currencies and the bond markets will behave as well.
So run us through the kind of impact you're seeing there, Mayuresh. We already, of course, saw the hit today. But going forward, how much more pressure that you see on some of those elements that you spoke about as well, whether it be the currency markets or the bond markets?
So again, from an Indian context, I think we are quite well placed in terms of our forex reserves are being maintained at this point of time. So India relatively probably is in a better cushioning position in terms of currencies. But if the dollar strength continues, my own sense is that the depreciation that you're probably expected to see across emerging pack might very well continue. And you might have the second round of a competitive depreciation probably happening, because if the currencies depreciate at the pace that they are, you're probably looking at the export competitiveness being challenged for a lot of these economies, whether that be in the Eurozone or the emerging pack. So I think that angle and that aspect has to be keenly watched out for. What also happens with the bond markets will be equally important. What happens to the German bonds, which have seen huge amount of negative yields come through? If there is excessive buying happening there, I think the yields will be pushed even lower. And what happens to the collateral economies within the Eurozone in terms of their bond positioning, whether that be Spain, Italy, Portugal? I think that needs to be cleanly monitored as well. So my own sense is that the risk off might very well continue unless you see some amount of stability, which might not happen over this immediate time period, and that might well get reflected in both currencies. As I said, bonds, equities have already seen the backlash of what we've seen today.
Okay, in terms of flows, Mayuresh, and I know you mentioned some of those domestic factors that could help to stabilize our markets, but capital flows, given that we may be entering a risk-off scenario, at least in the immediate to near term, what's your take on that, and how much, how much will that impact what we see on our markets going forward?
Again, I think all these issues will now come into the forefront in terms of how global liquidity will pan out in the first place. Secondly, as I mentioned earlier, I think India is in a very sweet spot compared to a lot of economies across the globe. Our reform processes are well on track. You're expected to see a good amount of monsoons come through, which will have revival in corporate earnings. You're seeing some stability in earnings on that front. With the expectations of GST, you'll see some addition happening to the GDP in the years going ahead. So the Indian economy is on a very strong footing compared to a lot of the other commodity-driven economies, and with lower commodity prices expected to come through because of this fallout, we are in a clear beneficial position as far as our current and the fiscal deficits are concerned. Having said that, foreign flows probably might be a little bit on the softer side, at least from a short-term perspective, till we get a handle on how these things are probably expected to move specifically in the EU zone. Until that point of time, you might see some muted flows come through. But from a longer time perspective, my own take is that it's only a matter of time over the next few months that the foreign flows might resume back into our economy, because we are probably one of the better placed ones, as I mentioned earlier.
Okay, let's take a very quick break. Here are a view from John Woods, Regional CIO of Asia Pacific at Credit Suisse. In a conversation with Bloomberg, he says while the trade impact on Asia is limited, the real risk is that of capital outflows. Listen in.
And I think there's been a very pronounced repricing of the expectations, obviously, that were in play maybe over the last 2 or 3 weeks or so. You know, we've seen a very broad expectation for Remain that now has to be aggressively repriced. And beyond that, we now have to start looking at the potential ramifications of the machinations of the UK leaving.
What's that in English?
Well, I mean, let me put this in another way. There is, in fact, a 2-year period between the vote...
Treaty of Lisbon.
And an actual exit event. And between that 2-year period, a lot of deals and trade agreements can be negotiated in different ways. Actually, that 2-year period can be extended with the agreement of both parties. So what's happening at the moment, I think, is very much a knee-jerk reaction to a completely and entirely unanticipated event, which has profound consequences. Now, the implications for me from this is obviously, as you pointed out, the flight to quality. I think now the US dollar is going to strengthen quite substantially. We're already seeing that. Does this mean, and I think it is, that Fed hikes this year are going to be pushed back well into 2017? I think we can expect monetary easing in the UK, in the ECB, and in the Swiss National Bank. This has quite a profound effect on asset allocation, which is obviously the business that we're in as it relates to risk assets and safe haven assets.
Have you seen markets like this before?
Yes.
Yeah.
We saw them, obviously, particularly around the Asia crisis. You know, we saw them around Lehman crisis. And the movement and the volatility that we've seen is on par, if not worse. I mean, I can tell you that volatility in sterling, for example, is much worse than it was during Lehman crisis. So these are not completely unprecedented. But the fact that it happened so quickly and so unexpectedly, I think just adds to the extraordinary nature of market action this morning and no doubt into next week as well.
When it comes to Asia, who do you think, or where do you think is best positioned in the light of Brexit?
Well, look, I think that is absolutely the question. You might be surprised, but we crunched some numbers a few days ago and learned that trade with the UK, as far as Asia is concerned, is equivalent to something like 0.5% of the regional GDP. So to be fair, the direct trading relations with the UK is de minimis, almost irrelevant. However, it's the capital flows, and precisely the point Rish is talking about, volatility in sterling, which is most critical for this part of the world. We are sensitive to volatility in currencies. We're sensitive to money exiting and leaving the country, and this is what is concerning.
John, when you say that you crunch these numbers, were you looking at visibles only, or were you looking at invisibles, of course, because don't forget the City of London has a profound impact, and that is a trade flow, let's face it.
It is, in fact, and you're absolutely right, we were just purely looking at trade, the flow
in physical goods.
Exactly. The flow of capital from the UK is actually huge, and you know, for countries like Hong Kong or areas like Hong Kong and Singapore, which are essentially financial centres, these have very profound impact on the fortunes of these countries. Away from that, capital flows as a proportion of GDP are most acute in countries like China and Korea. And so I think we would be quite cautious and need to analyse and examine quite closely the potential impact of continued volatility and dollar strength on those markets.
Mayuresh, it's hard to ask for strategies in a market like this, and particularly, we're also heading into expiry in a very sort of uncertain time in the few sessions ahead. But what would you advise? Would you be looking at themes that would perhaps be good value buys at lower levels on the back of near-term triggers like the monsoon, and increased expectations on consumption, or would you perhaps go for more defensive bets?
So again, I think one will be very, very selective. And again, I think if I keep a very optimistic view going ahead, my own sense is that if the markets decline further from the current level, any domestic consumption theme should do reasonably better, considering the kind of situation that we are in at this point of time. So domestically driven consumer staples, utilities, which have a rural focus, expecting monsoons to do exceedingly well this year, should do well. If I extend that theme to two-wheelers as well, which have a rural focus as well, I think those stocks should do seemingly well. With the seventh pay commission expected to come through as well, you'll have some amount of spending power specifically on these sectors. And within defensives, again, I think a few of the pharma companies where there have obviously been some amount of FDA concerns, the remedial issues will come through over the next year and a half. But again, I think if you look at the exposure that a lot of these companies have in the EU zone, I think the minimal exposed company towards EU or Britain in general, in my opinion, should do well, because I think the earnings growth specifically on the generic segment has been quite robust, and A&D pipeline for a whole host of pharma companies have been strong. So yes, I think consumer durables, two-wheelers.
Absolutely. And what happens on the commodity side, given the kind of pressure that we saw on some of those names towards the end of the week, on the back of the strength that we saw in the dollar as well? What happens there? What would you advise? Because we've seen a decent run up. We were starting to see some interesting views coming in. Is that all now in the past?
Have a few months data in place before you really take a larger call on the sector. With this event, again, I think you're probably going to look at how the Chinese demand-supply dynamics are expected to pan out. Secondly, I think the overall global demand-supply dynamics as well. And third, what probably happens specifically on the ferrous space as far as the LME inventory is concerned. So if you take all these factors into cognizance, my own sense is that there might be some amount of softness perceived as far as the demand dynamics are concerned, which might put pressure on the commodity prices from an immediate short to medium term perspective. If that probably happens, I think the inventory levels will probably shoot up. You might have some smelting capacity or production capacities across the ferrous space actually starting to shut down as well. But it's a matter of time. I think you need to have at least 3 to 6 months of data and a consistent data on that one to probably say that the commodity cycle is revived. But in my opinion, again, I think there would be some amount of softness because the demand dynamics probably would not be supportive from an immediate short-term perspective.
All right, fair enough. So that's on the commodity front as well. What about IT, Mayuresh, and what's your outlook there? Many of those companies with a huge exposure as well to the UK. We were taking a close look at Tech Mahindra, but even some of the other IT majors have quite a substantial, or at least a 15% or so exposure to business there.
Well, yes, I think for the zone as a whole, I think the exposure can be anywhere between 20 to 30% for a whole host of IT companies. Now, again, one really needs to understand over the next few months, once the exit process starts taking place, what kind of incremental action that will have in terms of the discretionary spend of a whole host of companies that the IT sector caters to within the UK and the Eurozone as well. So that might have some amount of implications as far as the revenue expectations are concerned. Secondly, I think the hedging policy will again be a little bit skewed for these IT companies, and that might have some amount of risk in terms of a margin hit. So again, I think there might be some amount of tapering going ahead in terms of top-line projections, some hit in terms of how the EBIT and the EBIT margins will pan out. But largely, I think one really needs to wait and watch. But I think top-tier IT, if it significantly declines from the current level, I think they become very attractive bets.
All right, Mayuresh, thanks so much for joining us on the show today. That's all from us. It's going to be quite an eventful week coming up as well, as the markets continue to digest all of the big news from the week that's gone by. That's all from us for now. Thanks for watching.